Hello everyone, and welcome to the Money Matters. Today, we'll be discussing the recent stabilization in the banking sector after a tumultuous month for global markets. Two significant developments in the U.S. banking sector have helped ease the recent disruptions. First, all loans and deposits from the failed Silicon Valley Bank are announced to be acquired by First Citizens Bank shares, ensuring continued customer account access and branch operations. Secondly, rumors suggest that U.S. authorities may expand the Federal Reserve's emergency lending program, offering more assistance to banks and potentially giving First Republic Bank extra time to bolster its balance sheet. First Republic's shares surged 25% before Monday's opening bell, while the broader S&P 500 stock futures rose 0.3%. In Europe, Deutsche Bank's stock recovered around 3% on Monday, after concerns over increasing bank funding costs led to a dip on Friday. Meanwhile, UBS slipped 1% amid a forced merger with failed competitor Credit Suisse. A key issue in the U.S. banking sector is the migration of depositors from smaller banks to larger, better regulated counterparts and money market funds. The latter experienced a record inflow of over $300 billion in the past month, reaching $5.1 trillion. During the week ending March 15th, deposits at smaller banks fell by $120 billion, while borrowing surged by $253 billion. Many analysts believe that the only viable solution to this issue is a significant increase in deposit rates at smaller banks or a drastic lending reduction, potentially leading to a credit crunch in the broader economy. Historically, the Fed has loosened monetary policy in response to such moves. Futures now indicate a two-thirds chance the Fed will maintain its position in May, while a July rate cut is priced at around 90%. On Monday, U.S. two-year Treasury yields edged up to 3.88%, but the yield curve between 3 months and 10 years momentarily dipped to its most inverted level in 42 years, signaling increased recession fears. Central banks are facing a dilemma as inflation remains high amid mounting banking stress. The Fed will closely monitor core PCE inflation data for February, while Eurozone data for March is also due this week. Economists expect the headline year-on-year inflation rate to have slowed to 7.2% from 8.5% in February, but the core rate, which excludes volatile food and energy prices, is predicted to hit a new record of 5.7%. Higher than expected German business activity data for March and ongoing labor strikes across Europe's largest economy add to the policy challenges faced by central banks. That's it for today's update on the markets. Don't forget to like, subscribe, and turn on notifications to stay informed on the latest financial news. Thanks for watching, and see you next time.